Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. And on the program tonight, I'm going to be catching up with Adam Dawes and talking about a number of stocks that really did last week and see what Shaw and Partners and their analysts are thinking about these companies. And then after Adam, I'll look at what the other analysts are saying, particularly on FN Arena, about these companies. In the Switzer report on Saturday, I portrayed them as the strugglers of the week, but I was quite surprised when I looked at what the analysts thought about these companies, and I raised the question, can losers be rewarding? And that's the theme of today's show. So without any further ado, let's go and talk to Adam Dawes of Shaw and Partners. Thanks for joining us, Adam.
It's great to be here, Peter. Thanks so much.
Yeah, mate, I looked at the stocks that did poorly last week. I portrayed them as the strugglers of last week on my Switzer report on Saturday. And I thought, well, let's have a look at what you guys are saying over there at the illustrious brokerage called Shaw and Partners. And some of these stocks are not my kind of stocks, but I was quite surprised. A lot of the analysts have some pretty positive views on them. Let's kick off with this one. Collins Food. I can tell from your very svelte physique that you're not a takeaway food man, but I bet you there's some people in your family who don't mind a bit of KFC or
yes,
stuff that
absolutely.
Collins Food owns.
Yeah. Look, it's an interesting one because Collins Food usually does quite well around this time, which is the summertime and cricket, because there's so much advertising that goes in, you know, the bucket heads and all the KFC advertising. It usually does quite well. However, I think this time around, I think Collins Foods probably needs to raise their prices, despite we're seeing some improving sales momentum. I think that overall same store growth or sales store growth is going to be a little bit tempered this time round. Even though I don't know if you or one of your family members have gone to KFC lately, Peter, but I would have basically that everybody has realised that prices have actually gone up, and it's not as cheap as what it used to be to get a KFC burger, a Big Mac, or anything like that. So the margins, I think, and it's really the input costs that the KFC are going to be struggling with, and that deflation or that operating leverage is really sort of hurt. So I think the first half result's going to be a little bit tough, and they might need to raise their prices a little bit to keep that margin going where it is at the moment. Yeah,
a lot of the analysts are implying that high interest rates are squeezing a lot of families, and therefore they're cutting back. They still might be going, but they're probably cutting back on what they spend, which could be their waistlines. Which who can argue that's a bad thing? Let's go to the next one. Siteminder.
Yeah, so Siteminder I think it's actually a really good little business. I think overall Siteminder has done very, very well, and it's just rolled off a little bit on the share price as we sort of speak. It has started to roll off a little bit. But one of those reasons why I think that is that it does have a foreign exchange headwind, and we do expect revenue growth to slow a little bit and potentially up to sort of 19% year on year, which could see another sort of 2% downside on the top line. But basically, we're saying that overall, the consensus are still fairly good for something like Siteminder. However, they've done very well in that mid-tier space. Now, Siteminder is a business where you can manage your hotel rooms, your bookings, all of those kinds of things. But it's never been for the top end of town. It's always for that mid-tier to lower-end businesses that need a booking engine, as it were, that's going forward. But if they do shift their focus towards larger properties, I think that might also reflect slower growth going forward. And I think that's where you need to see this potentially could be a 2026 story as that cost of living pressure starts to ease a little bit going forward. And they're obviously then starting to ramp up some new products or launching some payment terminals, which are currently in trial at the moment. So this one has done well for a couple of my clients, but I did actually sell out in the last coming couple of weeks. because of that shift in focus. And I'm a little bit concerned about how they're going to get those larger hotels, because something like the Hilton has a management system or a booking system already in there. So I think
Yeah.
they might be going after something might be a little bit tough, but it's an interesting story and something certainly to keep an eye on.
And it's fair to say that the impact of interest rate rises right around the world has obviously squeezed tourism. I
Yeah.
know a colleague's got an Airbnb place that was always booked, and now the bookings just aren't the same as it was the last few years. That's people feeling the pinch, and I guess
Mm.
everyone's looking for managing their costs on the business side. But yeah, it's a pretty good business, but uh, I think it's got a challenge from the rising cost of living for sure.
Absolutely.
Let's,
Absolutely.
let's get an Audinate, it lost a lot last week, 11.96%. But I noticed that
Mm.
the analysts still give it a big thumbs up. What's the Shaw and Partners view?
Yeah, look, we're still fairly confident that Audinate can actually, turn this business around. I think overall the business as a whole is a very, very good business, and disrupting in that space, which has obviously been their biggest thing, where they have disrupted and continued to disrupt in that space. And it's a very well-run business, and hopefully the video side of things can really start to move. But yeah, it has lost a bit of its market darling status after its last profit downgrade. And I think that then that is going to now continue to flow through until they can really sort of get the confidence back in the market.
Mm.
But overall, the business is very, very good. It does seem to be coming up against a couple of those struggles. And what was the price that you put on, or the downward
Yeah.
side of it, Peter?
Yeah, so it lost 11.96% to $7.80.
Yeah,
But the analysts have a much stronger view on where this is going, and I think five or six out of six gave it a thumbs up. But I think the overall view seemed to be saying not necessarily short term, but long term. There's a lot of confidence in the company.
yeah, very much so. We are, very confident on the long term. So I think this does provide potentially, you'd like to dip your toe in, but as we know, the first downgrade generally isn't the last downgrade, and potentially we've seen two downgrades now, so we might see a third one. So I'd be cautious of looking or dipping your toe in just at the moment on Audinate.
Yeah, this one that I don't really want to talk about because most of the analysts just don't have a high opinion of it at the moment, and that's Fletcher Building, which fell 8.93%. But do you guys have a contrarian view on Fletcher Building?
Excuse me. I think overall, Fletcher's obviously very much New Zealand focused, and New Zealand is struggling at the moment and is
Yeah.
continuing where we've seen interest rate cuts and then rise then cut, and I think they're a little bit ahead of the curve. So I think Fletcher Building is certainly one of those ones, but I'm not contrarian on this one. I certainly think that Fletcher Building is going to continue to struggle, obviously within that New Zealand operation versus the Australian side of things. I prefer a lend lease if you're going to dip your toe into something in that building side of things. I think lend lease. But yeah, I'd be careful with Fletcher at the moment. It does seem to be in a lot of trouble.
Yeah. That's now I can't help but talk about the lithium catastrophe. Right.
Yeah,
And Liontown is an interesting company, down about 14.38%, down to 63 cents. And it's the price that is getting me in,
yeah,
considering Gina Reinhart bought 19.9% of the company around the $3 mark, or going into the $3 mark, even a bit higher.
yeah.
And Abel Mahl was prepared to pay $3 for a takeover. And I'm just thinking to myself, okay, even if we've got a 2-year wait before people are buying
Mm.
vehicles and batteries like they're going out of style, to get in at 63 cents looks very enticing. But what are you guys thinking about this company?
Yeah, well, we always tell clients not to catch a falling knife. And
Mm.
this is where you got to be very careful, because I think potentially you can. Now, if you're a believer in the lithium story, then certainly it might be okay. But certainly the lithium market is more of a 2026 story versus what it is. Now, we've seen a lot of big companies start to shutter mines, care and maintenance, and that's bringing back the supply. The demand is still there. There's no doubt about it, but it's the supply side that they keep continuing to push through. So Liontown does look interesting. Certainly one of those ones. Even PLS, sort of near closer to $2 now. those
Yeah.
shorters were right, although, those months ago, they have been right, and it's continuing to slide on the downside. Liontown, though, it's an interesting one because you think, I mean, Rio's taking over Arcadium at the moment. I think that's an opportunity that, that's it's good for Rio. But I think Liontown, yeah, you want to be in the sort of the number one, number two. For me, that's IGO. For me, that's PLS in those bigger areas. And I think that's where you got to stick with the quality. Liontown's probably sits in that mid-range. And there's a reason why it's down here, but it is also very much to do with the lithium story, which I think is a 2026. So I think you got time to wait on that one, Peter.
Yeah, yeah, me too. Me too. Final one is a company that's, to me, it travels really well, and all of a sudden it gets shot down. That's Iluka Resources.
Yeah, yeah.
Dropped 12.59% last week. But the analysts really give it a nice thumbs up. And I guess what they're thinking is, because a lot of these miners have positive views, but I guess the argument is, well, interest rates will eventually help the global economy, and something like a Luke that sells a lot of stuff that other miners haven't got. Like they're the number one in so
Yeah.
many areas of interesting little mineral resources. But
Mm.
are you willing to take the punt on Iluka Resources now?
Yeah, look, it's interesting because China's definitely been playing around with the commodities, whether it's rare earths, whether it's rare minerals, and certainly that tit for tat that China's doing at the moment with the United States, saying you're not going to get access to these rare minerals. I know you need them to make your weapons, but we're not going to give you access to them. It certainly means that other businesses like Linus, like Iluka, start to become a little bit more attractive due to the fact that they're not in China. Two, America can use those businesses to get those rare earths or to get to get those substances. But I think overall rare earth prices and the creation of that ex-China rare earth market, which is now starting to happen, is a worthwhile investment. Now, that sell-off that we saw in Iluka does make it the risk reward more attractive. Okay. But I do think that there are the Australian government has started, and I think they've stepped in. The Australian government has put extra funding in for some of Iluka's rare earths, and that's a
Yeah.
significant taking out of significant uncertainties that now start to happen because the government stepped in and said, "Yeah, we're going to do this." I think overall, if we start to see an improvement in the rare earth price, that's certainly going to give me the confidence to dip my toe into something like Iluka. I own Linus. I think that's a better business. Gina Reinhardt's in there as well. She obviously thinks that's a one, but it is a high risk rating, and it's still there's a lot of brokers out there with a buy call on Iluka. So I think you just got to go in with your eyes wide open with this one and be careful because there could be some volatility both to the upside and the downside on this one. But a lot of those uncertainties now start to come out. Governments are now started to put the project financing in place. The ex-China rare earth market is now starting to move in the right direction. So it does look like something that I think I'd be interested to dip my toe in. But again, you got to be careful. It is high risk on these ones.
Adam, thanks for joining us.
Great to be here. Thanks so much.
Adam Dawes of Shaw and Partners. And that was Adam Dawes of Shaw and Partners. Now I'd like to have a look at what I discovered when I went to the analysts, particularly on FN Arena, to see what they thought about these companies that I identified as being strugglers. And it's always tempting to get on the bandwagon of stocks on the rise, but it also can be rewarding to look for a beaten up stock when the market has gone too far because the market is too short term in its thinking on the company. It's especially interesting when the cause of the stock price belting is because the international commodity price is weak. We've seen that with iron ore, we've seen that with lithium, reflecting a current problem that is likely not to last forever. If you want an example of a stock that's been beaten up, not because of commodity reasons, but for other reasons, let's have a look at Zip, which has surged this year by a whopping 481%, despite a 7.37% slump on Friday. Now, it looks like profit takers have been coming in to pocket the profit that they've made. And one in particular was Larry Diamond, who's the founder of the company. And Larry sold equivalent to 55 million shares and took away $100 million as he resigned as a director and the US chairman of the company. All right, despite the fact that Larry's done that, the analysts still like the company. They've got a 10.4% rise penciled in for Zip. I looked at the analysts, CBS, UBS, Audinate. They all like the company. UBS sees a 16% rise, Audinate sees a 14% rise. Citi is a little bit more careful at 0.32%. But the bottom line is this is has been a very good company to buy, despite the fact there have been a number of times when it has copped significant loss. It went down to about 50 cents at one stage and has now rocketed up to a price well over $3. Another company that copped it last week was Collins Food. Now, this is a takeaway food business that owns brands like KFC. It slumped 9.16% last week to $7.93. And there is a view that interest rates are really hurting lots of families and the consumer is challenged. And therefore, even if they are still going to their favourite takeaway venue, they're buying less and they're buying cheaper. And it's affected the performance of Collins Food. Now, despite all that, have a look at this chart. All the analysts really like this company. So it was a loser, but the analysts still like the company. Here's Morgan Stanley, 46.28% they think for Collins Food over the next year. And what's interesting when you look at the fact that Morgan Stanley is also one of the significant critics of Collins Food, they still have a 46.28% call on this particular stock. Another surprise stock price shocker came from Siteminder, which gave up 6.98% to $6.13. But the analysts see a 13.2% rise ahead. Siteminder helps out lots of hotels and the booking of their rooms and all the website stuff. Very interesting company. Have a look at the chart there. You can see 5 out of 5 analysts like the company. Citi sees a 24.8% rise penciled in for Siteminder. Once again, a loser who could be a winner. Now, one of my favourite currently disappointing stocks is Audinate, which lost 11.96% to $7.80 last week. This is what the analysts think about the company. The target price on average is $10.47, yet it's currently $7.80. The expected average rise then is 34.3%. The UBS is the most supportive of the company, and their analyst maintains a faith in the longer term fundamentals of the company. Have a look at the table. You can see there, Macquarie is fairly negative when you look at the commentary about the short term. They also give it the thumbs up long term, 30.77%. But look at UBS, 56.41%. Morgan Stanley, 34.62%. And Shaw and Partners, 15.38%. I think the point with Audinate is if you buy now, you may well be getting in early. But the view is that the longer term outlook for the company is very positive. Fletcher Building was a loser last week, down 8.93% to $2.60. The analysts aren't particularly interested in Fletcher. I think the fact that New Zealand is in trouble, going into recession, interest rates are falling. It's going to take some time for that economy to bounce back and start building again. And that's what Fletcher Building is involved in. Not interested in really looking at Fletcher Building at all. But two interesting companies are in the lithium space, and the lithium space really is struggling. I think Adam Dawes covered pretty well the Liontown situation. I'll give you what the analysts are saying. Remember, the current price is 63 cents. But if you, and Albemarle, the American company that wanted to buy it a bit over a year ago, was offering $3 a share, and Gina Reinhart bought 19.9% of the company, close to $3. So at 63 cents, you'd have to say it looks pretty interesting. The table sort of shows that most of the positives for this company range around 20 to 28%, but Bell Potter has a 124% price rise for the company. Really a supportive, but they do make the point, this is a speculative play. For those who really want to have exposure to lithium, I think Pilbara Minerals is probably the way to go. It fell 9.27% last week to $2.25, but it is a much more reliable play. Despite that loss, analysts see on average 28.9% upside for this company. Having a look at what the analysts say in this table, you can see there that there's a fair bit of support for Pilbara Minerals. Citi's got a 28% rise, Bell Potter 31, Morgan Stanley 33, Morgan's 44. Because it is a more solid company than most of its rivals, it is the kind of like the safety play on a speculative type business. As Adam Dawes pointed out, 2026 might be the time for lithium, and you're going to have to wait. But at the same point, markets anticipate those sorts of times, so they may well start buying sometime in 2025. So the prices we're seeing now may well be close to the bottom. For those people who are subscribers to this report, I'm going to have Mike Gable from Equities on the Boom Doom Zoom webinar on Thursday, and I'll get him to look at these two stocks to see if the charts are giving us a thumbs up for the near future. The final company I want to look at is Iluka Resources. I did talk about this with Adam Dawes. The share price tumbled 12.59% to $4.93. And I've got to say, this is not a company that's been one of my favorites, but Morgan Stanley maintains an equal rating on this company at $6.70. And we have a look at what they think about this company, 35.9% rise, Macquarie 44.2. You can see 5 out of 5 analysts like this company. And given what Adam was saying, given the fact that they've got government support for their production and exporting, it seems like an interesting one, and I wouldn't be surprised if it does well over the next year or so, provided we do see a global recovery that helps a lot of the commodity prices like iron ore, like lithium, and the other minerals out there, which we are famous for exporting. So that's the summary of a number of companies that all look like losers if you look at last week's performance, but the visionaries or the analysts looking down the time tunnel see a lot of potential for these companies, and it might be worth considering for your investments for the future. And that's the show for this week. Thanks for joining us. Remember, if you want to see the analysis of these companies in more detail, you will have to be a subscriber to the Switzer Report. I hope you can do it. It could be a fantastic Christmas present for you or someone who you love who'd like to be richer in the future. Once again, thanks for joining us. See you next week.